Thank you. Thanks, Anna, for that exceptionally warm introduction. That was, thank you. And thank you to Georgetown and to Anna and to Adam Leviton for the opportunity to speak to you today. I was particularly delighted to be asked to speak at today's conference because the topic is law and macroeconomics, which is a field that my experience has persuaded me is of the first importance, but ill understood and surprisingly understudied. Now, at first blush, that may sound like a beloved former president venturing into a grocery store. Golly, can you believe these scanners? Because the field of law and economics was already sturdily established when I was in law school back in the Coolidge administration and is now well over half a century old. It's been the source of some of the most innovative and influential legal scholarship over the lifetimes of everyone here. And in many ways, the insights of the law and economics movement have become the default framework that policymakers and practitioners alike use when we think about the law conceptually and often even at the level of granular application. But while we've called that law and economics, it would, I think we'd all agree, be more precise to call that law and microeconomics. Both law and microeconomics are centrally concerned with incentives. How are they constructed? How do they operate? How do legal or economic actors respond to them? And the interplay between these different ways to think about incentives has been a natural and fruitful focus of investigation in a broad range of legal studies: tort law, property law, criminal law, contract law, corporate law. But both law and economics are also centrally concerned with systems, the performance and relationship of broad aggregates of laws or economic activity, not merely how do individual actors react to changes in incentives, but how do large-scale combinations of actors respond to changes in systems? How are legal or economic systems constructed? How do they operate? How do those systems constrain wide areas of human activity? Now, the interplay between those two ways of thinking about systems would seem to be as natural and fruitful a focus of investigation as is law and microeconomics, but as Anna and Adam have indicated, it's only just beginning to be thought of as a field in itself. So for a concrete example of at least how I've been thinking about this, think about the often observed fact that corporate profit margins have been increasing steadily over the last few decades. Law is likely to have been a significant element in this evolution, but not any individual law, rather an entire system of laws relating to corporate governance, corporate combinations, taxation, litigation, labor, have evolved over an extended period of time. And under this theory, one outcome of this system, higher corporate profit margins, would likely give firms greater scope to increase wages without increasing prices, thus offering a potential explanation for the flattening of the Phillips curve, the traditional macroeconomic relationship between the unemployment rate and inflation. For a policymaker who accepted this theory, his comfort in maintaining a very low rate of unemployment could depend significantly on his understanding of that underlying legal system and his estimation of how its evolution in the legal environment would proceed in the future. Thus, the formal union of law and macroeconomics should seek to examine the interplay between a legal system and macroeconomic outcomes, above and beyond the connections that a particular law may have with its impact on short-term human behavior. Scholars and policymakers have spent our time primarily thinking about the impact of single laws, but it's appropriate to focus more broadly, especially since we have, in fact, repeatedly sought over the past century to revamp our system of laws to improve macroeconomic outcomes. Consider the debate in the half dozen years after the 1929 market crash that led to the establishment of the foundations of federal financial regulation in the United States. Laws creating the Federal Deposit Insurance Corporation, and a federal deposit insurance and receivership framework, establishing the Securities and Exchange Commission, greatly expanding the responsibilities and capabilities of the Federal Reserve System, were very purposefully intended to help restore confidence in the U.S. financial system as a necessary condition to foster a recovery from the devastation of the Great Depression. In essence, we designed and implemented a new system of financial regulatory laws to alter macroeconomic outcomes, not only to affect short-term individual behavior. The debate around those laws in the 1930s was not an academic one, because the pain and suffering of that era was evident. At the time, Congress was debating the Banking Act of 1935, which established the modern framework for federal bank regulation and supervision. The unemployment rate in the United States was still 20%. So I'll leave to others, or at least to another time, the question of whether every detail of the laws passed in this period was equally effective. Some of you may suspect that I have some views on that, whether in the short or the long term, in promoting macroeconomic stability. But we should recognize that rules to promote financial stability and a healthy economy have deep roots in the American legal tradition. So building upon that strong tradition, I want to focus my remarks this morning on the role that law and macroeconomics has since played since the financial crisis in promoting a more stable economy. I'm referring, of course, to macroprudential financial regulation. So let's rewind the tape a bit. After many decades of remarkable financial stability in the United States since the 1930s, the focus of financial oversight had moved away from systemic risks. Prior to the financial crisis, the better part of our regulatory framework was microprudential in nature. Individual laws geared toward mitigating the fallout from idiosyncratic shocks to firms. This framework was designed to protect investors and depositors, viewed negative shocks as not originating from the financial system, and did not take into account risks that might be shared by financial firms. It's not to say that regulators didn't understand the consequences of an interconnected system and the potential of contagion. For example, the U.S. government, under the able leadership of Treasury Secretary Nicholas Brady, recognized and responded to the financial stability risks of the Latin American debt crisis of the 1980s. The U.S. had geopolitical interests in stabilizing allies in Latin America, yes, but a central part of the motivation was to contain potential risks to the U.S. economy. The events of 2008 and 2009 redefined our mission by more explicitly connecting macroeconomic and financial stability as in the 1930s. Congress and the executive branch embraced a sweeping response, designing a system of laws to reflect a recognition that the cumulative, interconnected behavior of financial institutions as a system had implications for financial stability, and that even the behavior of a single large and complex institution could have implications for financial stability. This new system was also adopted at the international level, starting with the G20 summit in Washington, D.C. in November of 2008. The global community established the runway for structural change. The subsequent G20 summit in London led to the establishment of the Financial Stability Board, with a strengthened mandate as a successor to the Financial Stability Forum, and subsequently, including at the following summit in Pittsburgh, world leaders agreed that the supervision of individual financial institutions had to account for the financial system as a whole, and it was recognized that shocks could originate from within the system and could spread to institutions with common exposures. In other words, the supervisory framework had to be macroprudential, focusing on mitigating systemic risk and accounting for macroeconomic consequences. This reorientation was a defining part of the 2010 Dodd-Frank Act and internationally of the Basel III Accord. Section 165 of the Dodd-Frank Act in particular requires the Federal Reserve Board to implement heightened capital and liquidity standards, concentration limits, and stress testing, all to further the macroprudential purpose of preventing or mitigating risk to the financial stability of the United States. So as I'll discuss in a moment, the boards followed through with rules such as the GSIB surcharge, the liquidity coverage ratio, single counterparty credit limits, just to name a few. And importantly, we've used macroeconomic considerations in calibrating a number of these rules. Now, let's fast forward to the present. Over a decade has passed since the migration began toward a renewed focus on macroprudential regulation. Our evolution didn't stop with the Pittsburgh G20 summit in 2009. Indeed, global financial standard setters have continued to adapt and learn as they implemented and updated regulations in line with the global consensus that was reflected in Basel III. I'd like to highlight three important regulatory paradigm shifts that follow from this renewed focus on macroprudential regulation. First, in line with the pivot away from microprudential regulation, we have a renewed focus not only on the health of individual financial firms, but on the amount of capital in the entire banking sector. Now note that the idea of improving the stability of the financial system by regulating individual bank capital has been around for decades. Global policymakers began construction of the modern risk-based bank capital framework in the 1980s, when the aforementioned Latin American debt crisis increased concerns that the capital held by large international banks was deteriorating. And since then, regulators, such as the Board of Governors of the Fed, have continued to have one eye focused on the capital held at individual firms, but now, over a decade after the crisis, exercises such as stress testing have caused us to have the other eye focused strabismically on and assessing the amount of capital in the entire banking system. The second paradigm shift is that regulators have improved their methods of conducting quantitative analysis of regulations. Such analysis, including conventional cost-benefit analysis, traditionally did not take macroeconomic variables like gross domestic product growth or unemployment rate into account. That's no longer the case. Since regulators are given the task of maintaining the stability of the system as a whole, they must concern themselves with externalities and spillover effects to the broader economy. At the Federal Reserve, several regulatory initiatives have exemplified this change in the character, if you will, of quantitative analysis. At the height of the financial crisis, the Federal Reserve created the first stress test, the Supervisory Capital Assessment Program, or SCAP, to estimate potential losses at the largest banks if economic and financial conditions worsened. Building on SCAP, the Federal Reserve moved to the current stress testing assessment, the Comprehensive Capital Analysis and Review, or CCAR, to evaluate whether the largest firms have sufficient capital to absorb potential losses and continue to lend, even under stressful conditions. In the CCAR process, the Federal Reserve simulates macroeconomic scenarios like a recession in which GDP falls and the unemployment rate rises significantly. In the 2019 stress test cycle, for example, we tested banks against a hypothetical global recession in which the unemployment rate in the United States rose to 10%. The stressed banks were required to show that they could continue to meet minimum capital requirements in the face of those hypothetical macroeconomic shocks. Aside from CCAR, the Financial Stability Board compiles an annual list of global systemically important banks, or GSIBs, which are subject to stricter capital requirements in the form of a capital surcharge. These banks must meet this higher capital standard based on the judgment that their potential failure would have a larger system-wide impact on the economy. The goal, therefore, is to reduce a GSIB's probability of failure so that its expected impact on the economy would be the same as that of a non-GSIB. Similarly, to reduce risks of interconnectedness and contagion within the system, the United States and other jurisdictions have implemented rules that limit the exposure that one bank may have to a single counterparty. And finally, research on optimal bank capital levels by staff at regulatory and supervisory bodies around the world have factored in macroeconomic costs and benefits. Specifically, these models assume that higher capital requirements would reduce the probability of a financial crisis occurring, but would increase the cost of bank lending, thereby lowering GDP growth. Now, not surprisingly, these models have produced a wide range of capital estimates given the wide range of underlying assumptions, but the important factor is that they all take into account macroeconomic consequences in attempting to calibrate the legal and regulatory system. The third paradigm shift at the Fed is combating procyclicality. Now, to be sure, none of the regulatory developments that I've just been discussing so far screams macroeconomics quite as loudly as a time-varying discretionary regulatory regime, the express goal of which is to fight pro-cyclicality. Cyclicality, in this case fluctuations in the economy based on the business cycle, is a concept that's near and dear to every macroeconomist's heart. In fact, theoretical studies of economic cycles go back to the early 1800s, and the National Bureau of Economic Research's tracker of the U.S. business cycle dates economic contractions and expansions back to the 1850s. Quite impressive, although I suspect that the quantification, as one gets back there a bit, is aspirational, but nonetheless, quite impressive. There's also more than just a handful of volumes of articles and book chapters written on the business cycle and countercyclical fiscal policy. But in the context of macroprudential regulation, procyclicality represents a problem because banks tend to build up excessive credit during an economic expansion. Limiting procyclicality means limiting both the highs and lows of a credit cycle. Along with many other jurisdictions, the United States adopted a countercyclical capital buffer to address the issue, which we frequently call the CCYB. The U.S. CCYB is a capital buffer that ranges from 0% to 2.5% of the covered institution's risk-weighted assets. Domestic regulators have the discretion to switch the CCYB on or off anywhere within that range in order to prevent or mitigate the overheating of credit markets under their jurisdiction. In setting the buffer, the Federal Reserve takes into account, among other things, leverage in the financial sector, leverage in the non-financial sector, maturity and liquidity transformation in the financial sector, and asset valuation pressures. Notably, the CCYB is not calibrated bank by bank. It's not microprudential regulation. It's not calibrated asset class by asset class. Rather, regulators set the buffer based on their perception of the aggregate domestic credit cycle, whether it's too hot, too cold, or just right. Under the board's current policy, we would activate the CCYB based on when systemic vulnerabilities are meaningfully above normal. So based on this policy, the CCYB is currently set at 0% in the United States, but has been turned on in France, Hong Kong, Sweden, the United Kingdom, and Norway. Now, it's worth noting that in the United Kingdom, the CCYB has been set equal to a positive level, 1%, in normal times, as opposed to our framework, where we would turn it on when vulnerabilities are meaningfully above normal. As a result, their buffer can be adjusted upward or downward based on the perceived risks of the time-varying credit cycle. And as I've said in other contexts, I see real merit in exploring the UK approach as a tool to promote financial stability. So let me conclude these opening remarks by offering a few thoughts on three research topics that fall squarely in the intersection of law and macroeconomics. First, while international agreements such as Basel III demonstrate that the international regulatory community has agreed on the high-level systemic changes and developed similar perspectives following the crisis, national governments gave different regulatory powers in both degree and scope to their central banks in pursuit of the new post-crisis consensus. In the United States, Congress did not change the Federal Reserve's dual mandate, but did provide new responsibilities to promote financial stability. There was no change to the European Central Bank's monetary policy mandate, but it received direct supervisory authority over some of the Eurozone's largest banks through the single supervisory mechanism, and also continues to monitor financial sector risks. The Bank of Japan does not control Japan's macroprudential toolkit, but it does play an active role in monitoring systemic risk. The Bank of England, on the other hand, was explicitly given the task of a new financial stability mandate, and it directly oversees macroprudential regulation. In line with the debates over central bank independence and macroeconomic outcomes, legal scholars who engage in cutting-edge research on institutional design may have thoughts on which model leads to the best outcomes for financial stability. Second, in addition to giving varying degrees of power to their central banks, national governments also created new bodies that promote financial stability, such as the Financial Stability Board internationally, the Financial Stability Oversight Council here in the United States, to monitor systemic risk and to identify systemically important institutions and activities. For example, the main issue on the FSB agenda for this year were developments in financial technology, non-bank financial intermediation, the evaluation of our too-big-to-fail reforms internationally. In the same vein, the FSOC domestically produces annual reports that highlight such threats and vulnerabilities, including new ones, such as cybersecurity. Given today's audience, I'd very much look forward to hearing your thoughts on these issues, particularly suggestions on ways in which our legal framework can be used to mitigate these risks, and the extent to which additional macroeconomic tools should be developed to monitor or address evolving risks. Third, and finally, since I've spent a good part of this speech talking about issues that are near and dear to every economist, I feel like it's only fair for me to wrap up by discussing an issue of equal, if not greater, emotional import to lawyers, which is due process. Specifically, I'd like to close by talking about the due process considerations associated with the aforementioned macroprudential policies. There's nothing improper about mitigating negative externalities through regulation. That's an important purpose of much post-crisis financial effort. However, it's also well accepted that due process requires the fair, even-handed application of laws so that individuals are not at the mercy of an arbitrary exercise of government power. As I've alluded to throughout my remarks, we're currently placing a much greater regulatory burden on a select group of banks, the largest and most complex firms, because we believe that their failures could bring down the entire financial system. Some might argue that during the crisis itself, we dispensed with due process considerations while conducting version 1.0 of the stress tests. This is why I've strongly pushed for the recent shift toward greater transparency around the structure of the stress tests and the models themselves. It affords greater due process to the affected participants. In the same vein, I'd welcome greater legal scholarship on the due process considerations associated with bank supervision as a process distinct from bank regulation. By bank supervision, I refer to the processes and activities identified with examining banks, including checking compliance with laws and regulations, assessing bank capital and liquidity levels, assigning supervisory ratings to banks, taking formal and informal enforcement actions. While it's important for bank supervision to be up to the task of assessing the world's largest banks, and as we've discussed, it's important for it to evolve to taking into account systemic considerations as well as microprudential considerations, especially in light of the financial stability risks that I've been discussing today. An equally important task is making sure that our supervisors are acting fairly. Although questions of fairness are routine in law and economics, there's ample room to explore these issues as they relate to bank supervision. While transparency and fairness are pillars of due process, I appreciate that there are other approaches worth considering on this matter, and with this growing field of law and macroeconomics, I hope to see and implement many interdisciplinary solutions on the path forward. Thanks for your time this morning, and I'm happy to take some questions.
Okay. So
whatever's good. Do you want me to say? I'm at your service. I've always been at your service.
sit. I'll feel
Sit.
better.
Okay. Okay.
Thank you so much. Sereni, thank you so much. This is it's incredibly generous of you, as always. So here is how I would love to do this. If we have any students here at this early hour by student standards, and if you have questions, please manifest
The professors
yourselves.
in the room are laughing hysterically.
No, it's just like, look at how young they all look. And then if we could take a couple of questions from folks who are not members of the warmly welcome media. And then, if we have time left, and I'm sure we'll have time left, we would take any questions from any and all. So if you have a question, perhaps you could start by stating your affiliation and then ask the question. Wait, are you a student? No. You look like a student. Students, going once, going twice. All right, in the back, please.
Hi, morning. Thank you, Ms. Barbara.
Sure.
That's a consequence we have.
Sure, absolutely. So we look at, so we consider leverage in the non-financial sector, which includes both households and businesses, as you know, and everyone in this room is obviously aware that corporate credit, business credit, has been expanding significantly recently, and that the quality of that credit has probably also been eroding. When you look at the non-financial sector as a whole, however, you look at the households where the credit situation is actually quite solid. That's pretty good relative to historical levels. And so the two tend to, when you look at, again, in our taxonomy that we have of leverage in the financial sector, leverage in the non-financial sector leverage in the aggregate does not currently appear to us to be meaningfully above normal, but it's worth then looking a little more granularly at the corporate credit issue. And there we look at that, even if you were to look at that growing vulnerability, and I think that clearly is a growing vulnerability, but when you look at it in the overall context of the system and the other factors that we consider, probably the most important element is leverage in the financial sector, which is, at historic lows, extremely low given the amounts of capital and liquidity that we now require for institutions. And so that factor tends to swamp the other factors as we come to an aggregate assessment of whether aggregate financial stability risks are meaningfully above normal. And the current assessment of the board is that they aren't, and therefore this corporate credit development is not a financial stability risk. That doesn't mean that it's not a macroeconomic risk in the sense that a sudden reversion in the pricing of this class of assets could lead to an amplification of a business downturn. Not one that we think would have true financial stability consequences, but nonetheless one that might be worth tapping the brakes on with respect to its further development. The reason that way of analyzing the problem is important is because it talks about what the potential policy response ought to be. If we thought we saw financial stability risks rising as a result of developments in leverage lending in corporate credit, we would perhaps appropriately respond with a macroprudential tool such as turning on the countercyclical capital buffer. If we see this as more of a business cycle exacerbating factor, then the proper response is perhaps, as a supervisory matter, to tap the brakes on the erosion of underwriting practices in the area, which we have done through our Shared National Credit Program. Leverage lending has been a focus of the last two Shared National Credit exams, looking closely at these underwriting practices, and in the most recent one, we've pushed back against the development of some practices, which I assume many people in this room are familiar with, such as EBITDA adjustments, aspirational EBITDA adjustments, and automatically drawn incremental facilities that we think could lead to potential increased losses in this sector, and therefore would be appropriate for us to push back on.
Mr. Sobel, do you still have your question? Oh, wait, no, we have one more student. You're next. Sorry. I promise, you really are next.
It's like boarding an airplane.
Hey, it's exactly like boarding an airplane.
My name is Leland Smith. I'm a student. I'm a 3L here. One of the three shifts you mentioned from micro to macro was the focus on the amount of capital on the entire banking sector. Mm-hmm. I was wondering if that's specifically with regard to banking assets, or if there's also a consideration about non-banking, such as so-called shadow banks and insurance, for example.
So that's an excellent question, and the answer is that the great weight both of focus and of response in the evolution of the regulatory system post the crisis and the development of macroprudential regulation has been on the banking system, the regulated banking sector. We obviously have greater information than we used to have and put greater focus than we used to do on the evolution of vulnerabilities in the non-bank financial sector. Not that we were ignoring that before. That's one of the purposes of the Financial Stability Board in drawing together a broader range of regulators than simply the banking regulators that continue to gather in Basel with the Basel Committee on Banking Supervision, that we should, in thinking about financial stability, be taking into account a broader range of institutions and activities. But we have much less ability internationally and domestically to affect the aggregate capital levels, if you will, in the non-banking system. And in the way of thinking systemically, I think that we have to take that into account as we think about the entire system, as we consider the evolution of regulation for the banking sector. So to take an example. So the Federal Reserve has done macroeconomic work that would suggest that the proper, and I referred to this a little bit in my remarks, that the right range of the optimal level of capital in the system as a whole is between 12 and 24%. We're currently in the aggregate at about 14%. Different groups have had different estimates. The Reserve Bank of Minneapolis believes that we should have at least twice as much capital. The Bank of England has slightly lower estimates. I think they run from about maybe between 10 and 20 or a little below 20. That's heavily dependent on the assumptions that go into that about what the cost of a crisis would be. And in particular, one key assumption, if you were to keep one in your head as to what's driving some of these significant differences, Minneapolis assumes that the cost of a financial crisis in the future would be 120% of GDP. The Fed paper that we tend to refer to and use as our lodestar assumes the cost of a financial crisis to be about 40% of GDP. Both of those estimates are, materially above what most estimates are of the actual cost of the last crisis as a percentage of GDP. Therefore, the Bank of England uses a lower estimate of the cost of a future crisis. And that drives considerably these differences. But we need to have that sort of view. But those are pretty broad ranges, right, for the optimal level of capital. So where should we be between 12 and 24? I think we have to take into account that we can ramp up and be within an intelligent estimate of the optimal range of capital up higher in that continuum. But the clear cost is going to be that we will push some activities out into an area of the financial sector that we have much less visibility into and control over, that is less well capitalized and perhaps less well able to respond to a shock that could result from that activity blowing up if we pushed it out of the financial sector. So again, thinking systemically about this, precisely because of the question that you raised, I think that is a governor on where we ought to put ourselves within the continuum that's going to result from any level, any estimate of the optimal level of capital.
Thank you. All right, Mr. Sobel, you're on.
Thank you. Great presentation. Great to see you. Thank you.
Name, affiliation.
Mark Sobel, former U.S. Treasury person. Worked for several groups now. That question teed up mine perfectly. So, you did speak about macroprudential regulation in the banking system, which is up the Fed alley. But you didn't really talk so much about market-based finance, as it's called, or non-banks. And of course, if there are problems there, that's going to reverberate throughout the entire financial system and the economy. And that's really much more up the FSOC alley. Mm-hmm. So there have been those that have criticized the FSOC designation process for non-banks lately. There was a letter written by some of the people in this room that you probably read. Others have debated whether activity-based regulation suffices, whether there should be entity-based regulation. So I just kind of wanted to ask you, how concerned are you or not for the United States and internationally, given your FSB hat, that non-bank macroprudential oversight may be deficient, and how should it evolve? And you just said, well, we have to look at capital levels from the standpoint that there could be gravitation to the non-banks, but maybe if that's the case, you need to do something more in the non-banks. So if you could offer us your thoughts on that, I appreciate it.
Absolutely. So let me start first. So let me start first with kind of the FSOC process and entity versus activities-based designation, which which has been controversial. I think, but I think controversial in part because of what it might have been, as opposed to what I think has actually happened. So I do believe, just intellectually and conceptually, that thinking about activities as the potential source of systemic risk and therefore the target of systemic regulatory response is the right way to do that. I don't think that that kind of a process, thinking about activities in the first instance as opposed to the second instance, I think can lead to entity designation ultimately, and in the process that the FSOC has been describing could lead ultimately to entity designation, but that activities are the right first port of call. And just to use an example, again, that's currently topical that we were just talking about, leveraged lending. So given the structure of the way leveraged lending is operating and what we think the risks are, those loans are originated largely in the banking sector, and then they are largely sold outside of the banking sector, and they are widely distributed. And you've got many different purchasers, you've got CLOs, you've got mutual funds, you've got different types of holding vehicles, and then you've got different types of investors in those holding vehicles. So if you were to say today, is that a systemic issue? The response to it is almost certainly not going to be to designate any particular entity or even a group of entities as the locus of the systemic response. It would require saying, we think that activity is creating systemic risks, and then how do you respond to that activity? So, the FSOC has come up with, I was very heartened because I didn't know myself at the outset of the process whether it was going to be, a Potemkin Village process of really we're changing the character of designation as a way of saying there will be no more designations. But that really has not been how it's developed. I think it has been very clearly looking at what's the real source of systemic risk, how ought we to respond if that is the source of systemic risk, if we see an activity as opposed to an entity that's there. It's really quite carefully done, and it retains as a potential end result, continuing that we continue to have the ability to designate an entity if that's the right way to respond to a particular activity that's identified sometime in the future. Now, with respect to regulating the non-bank financial sector generally, so I do think that is something that we need to think about. What's the right way to address the risks of? I believe that after many months of negotiation, we have settled on calling it non-bank credit intermediation. Months spent deciding the shape of the table. But we need to think about that. I've been hopeful that, as you well know, Mark knows better than anyone in the room, really, it's very easy for those sorts of discussions about about non-bank finance in the international arena to degenerate simply into the rest of the world beating up on the United States and our evil financial structure. And therefore, it has instinctively been it's been the instinctive response of the United States across many different administrations and time periods to try to push back on having those issues discussed at all. If it's just going to be beating up on the U.S., then we'll take care of our own problems. We really don't need other people simply to shout at us in international fora. I am hopeful that having the FSB led by a U.S. person at this particular juncture can create sort of more comfort in the discussion, that we can grapple with these issues on a dispassionate intellectual basis without allowing them, again, simply to degenerating into the French beating up on the Americans.
Nothing against the French, right? This is, I think we're in free-for-all at the moment, so whoever you are, you may ask a question. There's a roving microphone. While the microphone gets to the gentleman named Mr. Truman in the front row, I just want to ask a very brief one, and feel free to answer it briefly. Is it something we've been struggling with mightily? You mentioned fairness in the due process sense, and there are related concepts of equity and, of course, the whole debate about inequality, right? Mm-hmm. And the extent to which and the way in which research in this field could address that, and in particular, the role of central banks. I mean, one way to look at the mandate is, unemployment certainly goes in that direction. But how would you think about central banks and inequality?
So I think central banks. Our tools for directly addressing inequality are limited, but they are not. They're not negligible, right? I think probably, I think this is probably fair to say. If you look over the course of the last decade, maybe the single most effective policy decision that was made that has sort of affected, reduced inequality, if you will, in the society, was the decision that the Federal Reserve made under Janet Yellen's leadership. I mean, it was her insight that you could have unemployment rates that were much lower than traditional. You could run a softer policy than I, sitting outside the Federal Reserve at the time, believed we could without igniting inflation, and she led the Federal Reserve to do that. And if you look at the distributional consequences of the current strong labor market that we have, those have been significant, right? So there are still gaps, but those gaps are smaller than they were beforehand. And so I have frequently said, and I have said it to Janet before, and happy to say it here as well. She was right and I was wrong, and that. Yeah, I will see what you say this afternoon, but
just keep that up.
But that has had important distributional consequences, and it's increasingly, in the minds of the Fed. Not that distributional consequences are an express target of what we do, but we have a much better understanding of what they're going to be of decisions that we take, and I think that's appropriate.
Thank you very much. So what we're going to do in the free-for-all stage is collect 3 questions at a time. Is that okay with you?
Sure.
Mr. Truman.
Ted Truman from the Peterson Institute for International Economics. So I thank you also for a very thoughtful and thought-provoking speech, set of remarks. I wanted to pick you up a little bit on your first topic for examination, where you emphasized that the responses of different authorities, national authorities, to the new regime, if you want to put it that way, post-crisis regime, have differed. Do you imagine that the fact that there are those differences could lead to conflicts or difficulties going forward? And do you see the FSB structure as a way to at least discuss these differences and maybe learn from them either way? I mean, so it's in some sense a policy coordination question that I'm asking, and the role that FSB might be in thinking about these differences.
Thank you. So 2 more questions. All right. You know what? We have 3 more questions. Let's just collect them all, and that
Okay.
way you can
Okay.
answer them all. 1, 2, 3. All right. Okay.
David
one more.
Morton. I wanted to ask a little bit more about that due process thing that you mentioned earlier. So it strikes me that if the Fed wants to penalize a bank with a monetary fine, it has to publish that information. But if the Fed takes sort of injunctive action against a bank, ranging from a matter requiring attention to an order not to grow, that doesn't need to be published, as far as I understand. And I guess I wondered if you thought that that was the sort of appropriate level of transparency for these sorts of injunctive kinds of remedies.
Hi, Victoria Guida from Politico. I just wanted to ask about regulatory reform broadly. You've been in this role for almost 2 years now, and I know there's still a couple of tailoring things you need to finalize here soon, and the stress capital buffer you're still working on. But how much work left do you think that you still have to do on that front?
And then one more there, and then we'll take one more round, and that's it. Right? So you will answer that one. Raise your- Oh, all right.
Yeah.
Is that okay? Do you
Hi,
have another 5
my
minutes?
name's William Edwards from Bloomberg News. What's your outlook on the economy, and do you see the need to provide more support to inflation?
I'm sorry, I didn't catch the last part of it.
Do you see the need to provide more support to inflation?
Okay, so that was the first wave. Okay,
There are only going to be 2 folks.
okay,
Raise
okay.
it high.
I feel like Johnny Carson and Amazing Kreskin. But so different national implementation and supervisory practices. Ted's question. I actually think that will be an important role of the FSB going forward. I was just the FSB has a ridiculously complex structure, but the first level of its complex structure are 3 standing committees, the main one of which is a committee on supervision and regulation that has just received a new chair, a Japanese official named Ryozo Humino. I was meeting with Ryozo yesterday talking about what his views and expectations were for the role of that committee going forward. And one of the things that he has suggested is exactly that, looking at how it could be that differences in supervisory practices around the world could have effects on financial stability that we might not appreciate. So again, without running too much into the weeds, but I do think it's important. So you look at the disruptions in the repo markets that happened over the course of the last week. One thing there are many causes of that, and I guess the first thing I should say is that when you look at those causes, they are either transitory or eminently addressable. Right, the transitory large demand for cash and certain factors that there are a variety of measures we can take. We haven't decided which we will take, but there are many measures we could take that ought to address that. One factor, however, that has been cited as potentially contributing is that in our supervision of liquidity requirements, not in the structure of the liquidity requirements themselves, but in our supervision of liquidity requirements, we have been in the United States, putting a thumb on the side of the scale of that banks should satisfy them with reserves rather than with Treasury securities. Now, for some time, I have been saying I don't think that we should do that as much as we have, that we have a regulation that says that you need to have high-quality liquid assets, and you can satisfy those with bank reserves or you can satisfy those with Treasury securities, and that if we sort of push on one side of that scale rather than another, it could lead to distortionary effects. That may have been part of what happened over the course of of the last week. Now, the reason that's relevant to your question is that, so we have some supervisory practices here that I think that we can modify in order to reduce potentially that result. But I realized during the course of that period, which is, I actually don't know how they supervise this in the United Kingdom, in Europe, in Japan, right? We have similar regulations, virtually identical regulations, but are they doing the same thing? Are they doing it more? Are they doing it less? Is there a risk that something like this could happen in their money markets? Could that feed back into us? At the moment, I don't know. I don't actually think that anyone knows. And the use of the Financial Stability Board and this Standing Committee on Supervision and Regulation, which has mostly been focused on regulation up to now, to also take the supervisory part into account, I think can be very useful. Due process. Injunctions don't need to be publicized. Is that right? So I don't have the answer to that specific question yet. What I do know is that over the course of the next couple of years, I want it to be an important focus of the regulatory process generally, and certainly what we do at the Federal Reserve, to think about exactly that, about exactly those sorts of questions. What do we do through supervision? What do we do through regulation? Where have we drawn that line over the decades? This is not just a post-crisis issue. This is something that has been developing over decades, that bank supervision, which once was Mr. Carter going into the Bailey Building and loan and ensuring that there was enough cash in the vault in It's a Wonderful Life, has become a vast panoply of actions that the supervisors and regulators take. And what falls on the regulation side of the line, which requires publication and due process and comment and input and cost-benefit analysis, and what falls on the supervision side of the line, which requires none of that, has happened largely accidentally as opposed to intentionally. I think we need to intentionally think about that distinction, draw a fair line, and you can imagine due process constraints around supervision that don't rise to the level of Administrative Procedure Act process, but nonetheless provide some warning, notice, opportunity for input appropriately, while nonetheless maintaining a firm and dynamic supervisory system. That's a hard question. I don't think that's an easy question, but it's an important question and one we'll be thinking about over the next couple of years. Regulatory reform, aren't you done? Can't you go back to Utah now? So I do think we focused very heavily on a program of regulatory reform that we could accomplish in the first couple of years for a variety of reasons. I think that was there were some clear things that needed to be done. We could think that through. We could get that done. But inevitably, there are some additional thoughts about regulation that will be worked out through the next couple of years. But this focus on supervision and due process will be extremely important. In fact, it may be that when I look back on my tenure in doing this, everyone thought that I was sort of supposed to come in with a flamethrower and set fire to Dodd-Frank, but that the most important thing that the Fed does during this period is to think intentionally again about what are we doing through supervision, what can we do through supervision, how do we make that effective but also fair. Outlook on the economy, need for more support for inflation. Fundamentally, the U.S. economy is quite solid. It is, every time I talk with bankers across the country, when we talk with our Reserve Bank presidents and the input that they receive from all of the different economic actors, sectors of the country, it's really quite positive with respect to actual activity, generally with respect to sentiment. There are issues about uncertainty around the global situation for firms that are particularly affected by that. There's uncertainty around trade policy for firms that are particularly affected by that. The trade policy issue in particular seems to have been weighing on business investment. And that concerns me because ultimately business investment is where we get the future productive capacity of the economy. which I had been quite confident about, but business investment has kind of fallen off of a cliff. I think that's a concern, but not one that affects the fundamental soundness of the current position of the economy. However, there are different views among the members of the FOMC as to whether the current level of inflation should be one of the drivers of how we think about policy. I am, I'm on the side of the argument that we don't need to be overly concerned about the current level of inflation, that we are a few tenths of a point short of meeting our 2% inflation target, if you will. Our measures of inflation are not terribly precise. The policy measures that we can take in order to try to affect it, act with very long lags, and our understanding of the relationship there is changing. I mentioned the Phillips curve issue in my remarks, which changes how one thinks about it. I do think that there's a possibility that one of the things we're seeing is that inflation is where it is because we have anchored expectations so firmly that everyone believes that the Federal Reserve will take care of this. They've got this under control. And that if we undertake the heroic measures that would be necessary to move inflation a few points higher in what seem to be the way the current, the macroeconomy is currently performing, that what we might succeed in doing is convincing people that, geez, they don't seem to care about this. They aren't going to do what's necessary to control inflation, and that the result would not be edging inflation up a couple of points, but actually unanchoring it, and where it goes, then we don't know. So that's my take on, is the current level of inflation a reason that we should be, trying to get that higher and setting policy to do that. But that is, there are a range of views on the committee about that question on inflation. That is not speaking for how the process is going to evolve necessarily.
So my job here is to be a total jerk and not let this take over the entire day, although it's an interesting question. We're going to, if you don't mind, taking one more round, because I am trading this off against lunch, and I think this is a worthwhile trade-off. So we'll take 3 more questions. Yes? Tops, 1, 2. 2 is great. Oh, 3. Right. Okay, that's it. Thank you so much.
So Peter Conti Brown from the Wharton School. I want to ask again about this due process, and I like the idea that in concept, it's a founding concept for our great republic. But I'm curious about how you recognize and quantify your sense of balance, because supervision, of course, requires a distance. It requires having a supervisory store that's not exposed to the supervised parties. And in particular, the mono model problem, that is a mouthful to say, but the idea that if stress tests are to be effective, they work in parallel and can't be exposed to Fed's models in their entirety. You might agree with that, but where do you strike the line, and how do you know that the line already struck is struck poorly?
So all great questions. So with respect to transparency, maybe it has to do with having grown up as a lawyer, although that does seem like a long time ago now that I practiced law. But I kind of begin from that the default view is that the government should be transparent about everything that it does, right? Whatever it is that's happening should be disclosed. That's the default, and that you need some argument, and it's a reasonably high bar for lack of disclosure. Now, we all know, there are things that we universally would agree should not be disclosed. The intelligence that we gather from covert operations is useful to us as a democracy, and we should not put on the website where all of our intelligence agents around the world are. The plans for tomorrow's attack in the midst of a war should not be publicized in a democracy. I think that there are reasonable constraints that all of us would agree should be applied to perfect transparency on the part of the government. But I think that that same principle then applies to what we do with respect to bank supervision, what we do with respect to the stress tests. Now, I have, I do believe that the model problem is a serious one, and for those who don't follow this deeply here, that's the concern that if the Federal Reserve disclosed all of the elements and models of our stress test, that the banks would simply do what we say as opposed to think independently about their own risks. And because these models are complex and inevitably judgmental, there will be idiosyncrasies and judgments and errors in what we do, as there are in the bank's own thinking. But if we disclose all of ours, the risks in the system will in fact coalesce around our idiosyncrasies, and it will create a more fragile system rather than a less fragile system. I'm persuaded that that's true, so I don't think that we should completely open our kimono with respect to the stress tests. But I think that we're not proceeding from that default position of we should disclose as much as is possible without running, while limiting that monomodel problem risk. So I think we've proposed some things that I think have been, have generally been perceived to strike that line, not in the, in the only ineluctable way that it could have been struck, but in a reasonable way to provide additional transparency without, which also is additional opportunity for everyone in this room. That's not just transparency to the industry, for everyone in this room to say, really, I didn't know you did that. Why do you do that? Reasonable transparency without that monomodel problem. On the question of how do we know that there's any problem with the way we have currently drawn the line between regulation and supervision, that's why I don't have a program today as to how we're going to change it. I think that is I think that's a hard question. I don't think that's an easy question. I think that is, I happen to think that it's intellectually a quite interesting question. It has been a terribly understudied question, even among experts in bank regulation and supervision. Among policymakers, we haven't really even thought about it. We just do some things through supervision and some things through regulation because that's the way we decided to do it this morning. So I think that's a hard call. That's a hard question.
So 2 questions together, and then you can pelt me with rotten vegetables.
Greg Gilzinis, Center for American Progress. So you brought up FSOC's interpretive guidance, and I was wondering if you could answer, why is it appropriate to consider a firm's likelihood of distress in the designation process when Dodd-Frank's first determination standard calls for the FSOC to assume material distress at the firm?
Eric Durden, University of Colorado. In looking at the repo markets, I'm wondering if you're also looking at the regulatory angle of whether banks are too dependent on short-term funding.
Super. So with respect to the first, likelihood of distress, so I myself don't believe that likelihood of distress should be a significant factor. I don't think that it is intended to be a significant gating factor in the determination of the of an activity. It is mentioned now, in fairness, I remember when I was a very young lawyer, again, this was back in the Taft administration, and preparing my very first bank loan document. I was quite proud of having thought about everything, and the partner looked at it, and against some of the risks that I had provided provisions for, said, yes, Randy, that could happen, and a pig could fly in backwards through the window in a helicopter, but we don't need to provide for it in the contract because that it will be excessive burden and people will think we're idiots. So I think I have viewed the reference to some consideration of likelihood of distress as opposed to being a material gating factor in the process to being some taking into account of exactly that factor. If you run into something that could be an issue but is as likely as a pig flying in backwards through the window in a helicopter, is there some way of taking that into account? But I agree with you that that should not be a material gating factor. On, do the recent incidents of the repo market suggest that banks are too reliant on short-term funding? I don't think so. Our assessment really is that the factors that led to that we understand pretty well, and those that are not transitory, that temporary demand for cash, are eminently addressable without materially reforming our regulatory structure. I don't think that they're being driven significantly by regulatory structure. May have been added to by some of our supervisory practices, which is something that we can change quite easily.
So please join me in thanking the Vice Chair for incredibly rich.